Yes, students, we will do module 36. In this video, we will explain about the computation of income from house property. So, we have completed the major part of syllabus, that is completion up to computation of taxable salary. Now, this is the new module. This is module showing or explaining the computation of income from house property. And in this, I will be explaining the theoretical concepts up to computation of expected rental value I will be explaining in this module. So the first thing I want to tell you, section 22. What is the basis of charge? As per the definition, three conditions should be satisfied to compute or to consider a person as the owner of a house property. First condition is property should consist of any building or land adjacent to that. A standalone building is not possible. So the building is the first condition. House property meaning a building. Sometimes it will be a standalone building and sometimes it will be the property adjacent to that. Sometimes it will be a garden. Sometimes it will be a kitchen garden in the backyard. Because a standalone building is not possible as per the municipality or the corporation rules. Usually some land will be around the building. Second condition is assessee should be the owner. So that is the second condition. Assessee should be the owner. So he has to be the owner of the house property. Legal title showing that he is the owner. Third condition is property is not used by the owner for any business or profession carried on by him. So you have to remember, if he is doing it for his business or profession, then it will be coming under computation of income from business or profession. Now the second point I want to explain is section 27, that is explaining about deemed owner. Deemed owner. Now what is the meaning of deemed owner? Deemed owner meaning maybe the legal title is not showing him as owner, but he is considered as owner for income tax purpose. So which all conditions a person is considered as deemed owner? First, the person transferred house property to spouse or minor child without adequate consideration and without any agreement to live separately. Usually this is the agreement, people will try to avoid income tax. So what they will do, husband will be the earning member. He will be already employed. So if income from house property will come to him, again his tax liability will increase. So he will show it as the house property is gifted to the wife or minor child. But actually the rental income will be legally coming to the husband. So this is just an adjustment to avoid income tax. So what they will do, the husband will be considered as the legal owner. He is considered as the deemed owner because he is enjoying the benefit from the house property. Second is holder of impartible estate. This ancestral property. If 5 children are there and only son, so that son will be keeping there or they will be living there, family will be living there. But all other children, other children also will have the right to go there and enjoy that property. They are also deemed owners because it's the ancestral property. Third is property held by a member of a cooperative society, company or association of persons. That is, if the apartment I am living, there are 8 apartments. So what we will do, all the 8 owners will have 1/8 share of the property. The property, that is the ground property, the ground level. Whatever the parking we have used, that is 1/8 ownership we have. We are all the deemed owners of that property. Not only the apartment we are having, plus the 1/8 share of the land in which the apartment is constructed. Next is a person who has acquired a property under a power of attorney transaction. A person not living in India, he is living in a foreign country, but he has rental income here. So what he will do, he will give the power of attorney right to a trustworthy person or a legal advisor. So for that, whenever he is holding that power of attorney, instead of the actual owner, whoever the power of attorney holder will be considered as the deemed owner. Next is a person who has acquired a right in a building through a lease. You know that people will take the buildings for lease, for business purpose, for accommodation, all that, for running hotel, hostel, anything like that. So if you are taking a lease for more than 12 years, then also that person who's holding that lease for more than 12 years or more is considered as a deemed owner. Now I have to explain the annual value. See, when we are dealing about house property, gross annual value, net annual value. These are the two basic terms used for computation of income from house property. So annual value is important. Now what is annual value? Rent received or expected rent a house property can fetch under given situation, and not only once but from year to year. That meaning whatever the rental value a building can attract. Now types of rental values are important. One is actual rent. Actual rent meaning rent paid by the tenant. It can be 50,000, 60,000, 12,000, 25,000, whatever the agreement between owner and the tenant. Second is real rental value. These terms are important. Real rental value. Real rental value meaning if you are living in an apartment, you have to pay the maintenance charges. Say for example, if apartment rent is 50,000 plus 10,000 maintenance charges. So here tenant will be paying 60,000, but 50,000 is the rental value, 10,000 will go to the association for maintaining the property. So that is the real rental value. We have to, this 60,000 is called the composite rent. Composite rent minus 10,000 maintenance charges, that is 50,000 will be the rental value. Now municipal rental value, MRV. These short forms are important. That is the value fixed by the municipality. Next is fair rental value. Fair rental value meaning that is rent prevailing for a similar accommodation in a locality. Imagine a building with 10 apartments. You cannot say that one apartment is getting 1 lakh, one apartment is getting 25,000, one apartment is getting 50,000. Whatever that one apartment is taking, that they will consider it as base. But the other apartments, the income tax department will feel that they are showing it for reducing their tax liability. Whatever they are supposed to get, they can get that. That is the fair rental value. The fair rent, whatever the building or the apartment can fetch under similar situations from similar buildings. That will be the base for comparison. Next is standard rent. This is the rent fixed by the Rent Control Act. Standard rent. Standard rent when a locality is fully developed. So then standard rent will be fixed. Now computation of expected rental value. See, the term standard rent is important. Standard rent. Standard rent is important. From this we will calculate the expected rental value. That is the first step in computation. So first standard rental, expected rental value computation is divided into two. One is if standard rent is not fixed, and second is standard rent is fixed. Now when standard rent is not fixed, a locality which is not fully developed, a newly formed locality, slowly people will start constructing. Then when it will become a full-fledged, the municipality, corporation will provide all the facilities like electricity, water, like that. Then it will be fully developed. That time they will fix the standard rent. Before that it will be a developing locality. That meaning standard rent may not be fixed. Once it's fully developed, standard rent will be fixed. So if standard rent is not fixed, we have to consider municipal rental value, fair rental value, and actual rent received. Between these three values, it will be given in the problem. Whichever is the highest value will be taken as the expected rental value. Expected rental value. Short forms are important. Then we will use these short forms in the computation. So when standard rent is not fixed, this is the method to compute. Now the last topic I want to explain is if standard rent is not fixed, then you have to do some simple calculation. You have to compare between municipal rental value and fair rental value. Fair rental value. Between these two values, whichever is higher is taken. Here if you imagine, this is 25,000 and this is 35,000. So here comparing these two values, 35,000 we are taking. Now you compare this with the standard rent, because here standard rent is fixed. That meaning imagine if it's 20,000. So first step we have decided 35,000. Between these two values, the higher value we have selected. Now next step, between these two values, the lower value we will take. That means it's 20,000. 20,000 will be the expected rental value. This is what I wanted to explain in this module. Happy learning. Thank you.